Well, Vodacom is majority owned by Vodafone, one of the world's largest mobile companies. Vodacom has operations in South Africa, Tanzania, the DRC, Lesotho and Mozambique. The company has a market cap of 156 billion rand, a price to earnings ratio of 15 and a dividend yield of 6.7%. There's no arguing with that dividend yield. This is a cash cow and they're giving money back to their shareholders. Jean-Pierre.
Yes, and the shareholders have really been liking that strategy, as you can see in the share price, all the way up almost in a straight line with a bit of a wobble there at the end. And that is probably the question about the sustainability of that dividend yield, of this big free cash flow that's generated by the company. Is it sustainable or not? And investors have got different views in that regard.
Craig, what's your view? Are we sustainable on the cash flow side of things when it comes to Vodacom?
Well, look, they've guided as a dividend payout ratio of 100%. So all the earnings are returning to shareholders. And I think the theory is that a lot of the capex they will spend in that current year from the cash flow in that current year. So it's very cash generative. And at the moment, sort of 85% of revenues coming from South Africa represents about 94% of profit. But if they do something aggressive in DRC or Tanzania or Mozambique, and maybe even in Ghana, because that's where they're finding shareholder, well, their current shareholder Vodafone has got operations, then they will need capital. But whether that capital will be supplied by Vodafone or whether they're going to reduce dividend remains to be seen. And I think there is a little bit of uncertainty. Otherwise, the share price may be a little bit higher if there was certainty around those dividends, because certainly 6.7% is rather attractive.
Well, we've got a change of guard happening as we speak at Vodacom. Peter Ace will be stepping down and Shamil Yusuf will be taking over as CEO. Do you think Vodacom now continues to be in a safe pair of hands? Of course, Peter Ace has delivered great returns for shareholders over the years.
He has, but Shamil was the MD of Vodacom SA a few years ago before he went to Spain and became the MD there of the Vodafone Spain operations. So a very safe pair of hands. He knows the Vodacom business extremely well. And I don't foresee any trouble with the new management, the new executive coming into the hot seat. The big question is about the tariffs that they charge. So we know that cell phone rates in South Africa are extremely high, higher than where they are in other places in the world. And the question is, if there is enough competition, will there be pressure on those tariffs, and will there therefore be pressure on Vodacom's revenues? Our view is, even though on a per minute basis there could be pressure on tariffs, people will talk more, and your elasticity of demand is such that they will sustain their revenues, and with data revenue coming in as well, that'll give them single-digit growth in revenues, and that will sustain the current dividend yield.
Craig, if you wanted telecoms exposure, if you bring MTN into the mix, would you go for MTN or for Vodacom? This is before I get to hot or not.
Okay, so look, Vodacom's on a conservative PE of 15, but I would prefer MTN because of its growth prospects, notwithstanding issues it might have in the Middle East at the moment. But certainly Nigeria, they've got traction, and I'd rather be one of the first movers in a country on the African continent than on the back foot, which Vodacom will be as they move into Ghana, Kenya, and more aggressively maybe on the back of Vodafone. So from that point of view, I'd say currently I prefer MTN.